Just yesterday, the Federal Reserve concluded its final FOMC meeting of the year. As you've seen on Bloomberg terminals and major financial news outlets, every word from Powell sent shockwaves through the markets. Bulls and bears battled over the minutiae of the dot plot, while implied volatility in the options market swung like a roller coaster. If you're currently glued to your screen, trying to decipher subtle adjective shifts in the Fed statement or attempting to predict Monday's opening market moves through macro analysis, I must reveal a harsh truth. You're wasting your time. In 2025, dominated by high-frequency trading, quantum computing, and generative AI, trying to beat the market through macro timing is no longer a difficult game for individual investors. It's a game destined for failure. Today, please temporarily mute those noisy news alerts. We need to talk about a true invisible operator. Over the past 15 years, his total return has crushed 99%. Not an exaggeration, but a statistical 99% of those highly paid Manhattan office-dwelling professional active fund managers. Even the revered Oracle of Omaha, Warren Buffett, has had to acknowledge this operator's dominance in the recent tech boom. This operator has no emotions, knows no fear, understands no greed. He doesn't need rest, nor will he tremble at his trading desk after too much coffee. He's a cold, unfeeling code, automatically executing ruthless survival of the fittest each year, kicking out laggard old economy companies, and unhesitatingly pouring capital into the next Nvidia, the next Tesla. If you're still searching for the holy grail to navigate bull and bear cycles, the answer has been right under your nose. It's the most misunderstood, yet most powerful wealth machine, the Nasdaq 100 Index. We'll strip away all marketing noise, from data logic and product matrix to practical strategies, providing you with the most comprehensive survival and wealth-building guide for this AI-dominated era. In finance, there's an open secret. Hard work doesn't guarantee wealth, and in secondary markets, hard work often leads to losses. The SPIVA report published annually by S&P Dow Jones Indices is known on Wall Street as the death sentence for active fund managers. Unfortunately, most financial advisors will never show this report to their clients. Let's examine the latest data as of the end of 2025. Over the past decade, more than 92% of US large-cap growth fund managers underperformed the Nasdaq 100 index. Extending the timeline to 15 years, this failure rate rises to a staggering 98%. This is an extremely counterintuitive statistic. In life, we believe in no pain, no gain, and trust in expert capabilities. But this logic fails in the stock market. There are three main reasons for this phenomenon. First is the mathematical black hole of fees. Active funds typically charge 1% to 2% in management fees, some even with performance fees, while ETFs like QQQM have an expense ratio of only 0.15%. This means active fund managers must outperform the market by over 2% annually just to break even with the market, an almost impossible task in the highly efficient US stock market. Second is human weakness. Fund managers are human. They panic sell during the 2022 crash and face pressure to chase highs during the 2024 to 2025 AI frenzy. Fear, greed, and redemption pressures from investors lead to distorted actions. Third is overtrading. Frequent buying and selling not only increase transaction costs, but also create tax burdens. Therefore, when that well-dressed financial advisor in the bank recommends a so-called 5-star star fund, from a probability standpoint, there's a 90% chance they're selling you an inferior product destined to underperform the market. In this era, relying on human effort to beat cold algorithms is like trying to outrun a Ferrari on foot. Many conservative investors might say, if I can't pick stocks, then buying the S&P 500 is the safe choice, as Buffett himself recommended. Indeed, the S&P 500 is the bedrock of the US economy. It's safe. However, in 2025, we must face a reality. The S&P 500 is too heavy and too slow. The S&P 500 includes a large number of utilities, traditional energy, consumer staples, and traditional financial stocks. These companies are profitable, like banks and Coca-Cola, but their growth is linear, even stagnant. They're elephants, and elephants can't dance. In contrast, the Nasdaq 100 index excludes all financial stocks, focusing purely on technology, biotechnology, communication services, and high-end consumption. It's a pure growth engine. Let's look at the data. As of December 2025, including reinvested dividends, the S&P 500 ETF, SPY, delivered an annualized return of approximately 15.1% over the past 15 years. Berkshire Hathaway, BRK, about 13.8%, while the Nasdaq 100 ETF, QQQ, achieved a whopping 19.64% annualized return. A 4.5% annual difference might seem small, but under the power of compounding, it's not just a gap, it's a chasm. Assuming you invested $100,000 15 years ago, SPY would now be worth $820,000. while QQQ would be worth $1.47 million, a full $650,000 more. This is the power of choice. According to Invesco's deep attribution analysis, the core reason for Nasdaq's outperformance lies in the R&D mode. S&P 500 constituents spend an average of 8.6% of sales on R&D, while Nasdaq 100 constituents spend 10.7%. It's like two young people. One spends their earnings on luxury goods and bank deposits, while the other invests in cutting-edge AI technology, startups, and betting on the future. Who will be wealthier in 10 years? The answer is self-evident. Buying the Nasdaq 100 isn't just buying stocks, you're buying the rate of human technological progress. As long as you believe next year's computing power will be stronger, algorithms smarter, and medical technology more advanced, you should firmly stand with the Nasdaq. The most fascinating and terrifying aspect of the Nasdaq 100 index is its self-evolutionary capability. It undergoes a massive rebalancing every December. This is a great purge devoid of sentiment. No matter how glorious your past, Yahoo and Cisco were once kings. If your market cap falls short of standards, your weight will be ruthlessly cut or even kicked out of the index. No matter how controversial you are now, early Tesla, Moderna, or the latest AI application layer companies emerging in 2025, as long as your market cap meets standards and liquidity is sufficient, the index will automatically absorb you. This forced metabolism ensures you always hold the 100 strongest non-financial companies on Earth. You don't need to study financial statements or dig for insider information. The index's construction rules have already thrown the trash in the dumpster and kept the gold in the safe. If you pick stocks yourself, you might cling to a declining company due to emotional attachment, but the Nasdaq won't. It's decisive, always young. Now that we've established the Nasdaq 100 as the optimal target, how do you actually buy it? This is where true skill is tested. Many retail investors only know the ticker QQQ, unaware that Invesco has designed a complete product matrix for different investor profiles. Choosing the wrong tool is like using a scalpel to chop wood, highly inefficient. First is the flagship warship, Invesco QQQ Trust. QQQ, positioned as the king of liquidity, the preferred choice for institutions and traders, with an expense ratio of 0.2%. QQQ, launched in 1999, is one of the oldest ETFs, with its core advantage being unparalleled liquidity. Its bid-ask spread is virtually zero. You can instantly trade hundreds of millions of dollars without slippage. Most importantly, if you're an options player, say doing covered calls or selling puts to buy the dip, QQQ is your only choice, as its options chain is incredibly deep, with dense strike prices and rich expiration dates. No other variant can match its options liquidity. For ordinary investors, I highly recommend the stealth champion, Invesco Nasdaq 100 ETF. Positioned as a savings jar for long-term holders, it has an expense ratio of only 0.15%. QQQM, launched in 2020, has identical constituents and weights to QQQ. The only difference is its lower cost. Its unit price is typically lower than QQQ, making it convenient for small amount dollar cost averaging. Most crucially, its management fee is 5 basis points lower than QQQ. Don't underestimate this 0.05%. Over a 30-year compounding period, assuming a $100,000 investment, this tiny difference can save you thousands of dollars in fees. Therefore, if you don't trade options and plan to hold for over a year, choose QQQM without hesitation. Don't give Wall Street an extra penny. Additionally, there's the next-gen star, Invesco Nasdaq, next-gen 100 ETF, positioned as an incubator for mid-cap growth, selecting companies ranked 101st to 200th on the Nasdaq. This is the unicorn breeding ground. Companies like early Tesla and Netflix completed their most explosive growth phases in this range before entering the Nasdaq 100. Companies in QQQJ are typically in high growth stages. With AI applications spreading to SaaS and healthcare technology in 2025, their explosive potential is immense, but so are the risks and volatility. It's recommended as a satellite allocation. Another is the cash cow, Invesco Nasdaq 100 Covered Call and Growth ETF, a defensive tool for passive income suitable for retirees or investors needing cash flow. It holds Nasdaq 100 stocks while selling call options to earn premiums, providing a monthly dividend of around 13%, negative 14% annually, and some downside buffer. However, in strong bull markets, its sold options limit upside potential, potentially underperforming QQQ, making it more suitable for sideways or slow bull markets. Next, we enter the professional domain, the source of countless retail investor losses, leveraged ETFs. The ticker TQQQ, ProShares Ultra Pro QQQ, is 3x leveraged long the Nasdaq 100. During the 2010 to 2021 bull run, it created over 100x returns with impressive gains in 2025 as well. Many mistakenly believe that if they're bullish on long-term growth, buying 3x leverage will yield 3x profits. This is fundamentally wrong. The biggest pitfall of leveraged ETFs is volatility decay, a pure mathematical problem. Assume the benchmark index drops 10% on day 1 and rises 11.11% on day 2, returning to its starting point with no net gain or loss. However, TQQQ would drop 30% on day 1 and rise 33.33% on day 2, resulting in a net value of only 93.33, a 6.7% loss. Even if the index doesn't fall, as long as it fluctuates wildly within a range, TQQQ's net value will be continuously eroded. Therefore, TQQQ strictly prohibits blind long-term holding. It can only be used in clear one-way bull trends with strict stop losses and risk management. As for SQQQ 3x short, my advice is to avoid it. SQQQ holders suffered massive losses in 2025, the US stock market trends upward long-term, and shorting is going against the tide. SQQQ's only use is as a short-term hedge against extreme black swan events when holding large Senho profits. Holding it for over a month is simply throwing money away. With the tools understood, we need to formulate tactics. For different risk appetites, I've prepared 3 strategies for the post-2026 market. The first is the core satellite strategy, suitable for most middle-class individuals with full-time jobs seeking stable growth. Allocate 60% of funds to QQQM as a ballast, holding it long-term without moving, 20% to QQQJ to capture mid-cap high growth, and 20% to semiconductor ETFs like SMH. In the next decade, computing power will be the hard currency of the AI era, and this allocation significantly enhances the portfolio's offensive power. The second is the barbell strategy, suitable for extremely conservative yet greedy investors or high net worth individuals. Allocate 80% to 90% of funds to short-term treasury ETFs, like SGov, currently offering around 3%, -4% risk-free returns, ensuring absolute capital preservation. The remaining 10% to 20% goes all in on TQQQ. This leverages the anti-fragile logic. Even if TQQQ goes to zero, only a small portion of total assets is lost, recoverable through treasury interest over a few years. But if TQQQ doubles in a bull market, total returns will be astronomical, using limited losses to bet on unlimited gains. The third is the value averaging method, suitable for advanced dollar cost averages with stable cash flow and strong discipline. Unlike regular fixed amount investing, value averaging requires setting a portfolio value growth target. For example, requiring the account value to increase by $1,000 monthly. If the market crashes this month, causing the account to shrink, you need to invest more than usual to meet the target, forcing you to buy more at lower prices. If the market surges this month, causing the account to exceed the target, you not only don't need to invest, but may even need to sell some, forcing you to take profits at higher levels. With QQQ currently near historical highs, this method effectively prevents emotional buying at peaks while preserving cash for potential pullbacks. In this era of information overload, we're bombarded daily with noise, Fed minutes, macro data, geopolitical crises, which not only drain energy, but also induce poor decision-making. The Nasdaq 100 index isn't just a string of code, it's a collective bet on human optimism. When you buy QQQM, you're essentially placing a bet. You're betting that despite short-term volatility, humanity will continue to innovate. You're betting that engineers will write more efficient code. You're betting that scientists will discover more advanced materials. You're betting that as long as the Earth doesn't explode, the wheel of technological progress won't stop. If you believe in this fundamental logic, beating Wall Street isn't difficult. Even if you can't read candlestick charts or analyze financial statements, as long as you're on the side of the trend, time is your best friend. Forget those pundits trying to predict next week's market moves. Fire those expensive financial advisors who consistently underperform. Embrace QQQM, cultivate patience, maintain liquidity, and stay invested. Investing isn't an IQ contest, it's an endurance race. Plant the seed of technology today, nurture it with time and faith, and in 10 years, you'll have your own forest. This is the only path for ordinary people to achieve class mobility in this brutal AI era.